Good morning, everyone. I think we're going to get started. I think we have everyone out of the waiting room. I want to thank everyone for joining us this morning for the 2020 year-end tax update with William Vaughan. If you could all please mute your devices and turn off your video, that will help with streaming during the presentation. As always, we want to make sure we thank all of our sponsors: William Vaughan, Highland, Huntington Bank, Fifth Third Bank, Shoemaker, Loop and Kendrick, Eastman and Smith, Skylight, and Raymond. And presenting this morning, we have Ruben Becerra, who is a tax manager with William Vaughan since 2013. His specialization is in federal, state, and local tax compliance and planning opportunities for middle market corporations, partnerships in the manufacturing, professional services, and real estate industries. We also have Mike Hanf, who is a partner with William Vaughan Company with more than 20 years of experience advising entrepreneurs, family-owned businesses, and Fortune 1000 entities on a wide range of tax planning business matters. So what we are going to do is our normal format, and for those who have not joined us on a webinar before, please do mute your device and turn off your video and utilize the chat for questions. They're going to hit a number of topics regarding tax planning. If you want to send a chat to everyone with any questions, we will moderate those throughout the event, and Ruben and Mike will be able to answer those as we go. And then we will wrap it up at the end with questions as well. So I'm going to hand it over to you guys. Thank you.
Well, thank you, Emily. Thank you very much. Welcome, everybody. As Emily said, we're going to bounce through a multitude of I guess, topics here. And really our intention isn't to go in depth into any one given topic, but maybe more kind of bounce through a couple different ones and really bring some awareness to those items. I would frame both Ruben and I as being more generalist. So clearly feel free to ask any and all questions. Hopefully we'll be able to answer them all, but if we're not, we'll definitely get the answers back to Emily, and then she'll be able to disseminate those out to the group. So please feel free to use that chat. Both Ruben and I will be kind of watching that too, and we'll kind of interject some kind of answers in there as we go. As far as kind of the topics that we're going to bounce through a little bit, we figured that with kind of the PPP forgiveness, the applications being submitted, not going to spend a lot of time on this, certainly not going to be a PPP webinar, but really just more of a kind of current state. And so some things to be considering, both specific to the PPP forgiveness and also the EIDL loans that are out there. We believe we know where the election is going. So we're going to go through kind of what some of Biden's plans are, just so that if we had a crystal ball, what sort of things might we be thinking about from a planning standpoint? And then kind of specific to some of these kind of future changes, we'll kind of speak to some estate planning ideas, and then also some income tax planning ideas. And with that, Ruben, the floor is yours.
Perfect. Thanks, Mike. Yeah, so as Mike mentioned, obviously the PPP loan stuff has been heavy on our minds throughout the year, and there's been a lot of changes throughout the year. A lot of things that we've been trying to monitor. And we just wanted to, give a brief status update on where all that stuff stands. So most banks are now accepting forgiveness applications. I know I have several clients that have kind of already gone through the process and have their forgiveness done. Other clients that are kind of making their way through it. But that is something that you can get the ball rolling on now. So there's SBA forms 3508 and then 3508EZ. Kind of the two main forms. The 3508 is the regular application, and the EZ form for businesses that didn't have any employees. And then there's also the form 35, which is just a more streamlined form for any PPP loans of $50,000 or less. So it's and Mike, correct me if I'm wrong here. But our understanding is that if you're eligible for the EZ form and the S form, that the S form is still the easier form to fill out. It's more of a certification as opposed to needing to get the information down on the application.
Yeah, you're absolutely right. So if you go through those questions and you say, well, I qualify for the easy, why wouldn't I just do the easy? Even the easy form has just some numbers where you're filling out the form with those amounts. If you are under $50,000 and you follow the 3508S, you don't even have to put those amounts onto the form. Now, some would argue that's a minor difference. Theoretically, you still have to calculate all the amounts to be able to certify on the 3508S, but nonetheless, just completing the form, the 3508S doesn't even have the numbers on it, versus the easy form does actually have numbers like what was your total comp, what were your rents and utilities and kind of things of that nature.
Yep. And so on top of that, the SBA also has an additional form out there, the 3509 form, which is a loan necessity questionnaire. And that's only for any businesses that got PPP loans in excess of $2 million. And what that is just them kind of vetting out that information that those businesses put on their original application and making sure that they got the loans for the right reasons, that they got it out of economic necessity, that they got it to continue operations, and there was nothing other than that for the reason. Next is the tax deductibility of those expenses that you paid with the forgiven loan amounts. So this is definitely something that's been a hot topic throughout the year, and something that I think the accounting community at large isn't really in agreement with the stance that the IRS has taken. So back when the CARES Act came out, I kind of said PPP funds were meant to be non-taxable funds. That's kind of what we believe that the intention of the bill was. The IRS, though, pretty early on came out with some guidance that said, fine, it doesn't have to be included in taxable income, but you're also not going to be able to deduct the expenses that you paid with those forgiven funds. And so that they can kind of frame it any way they want to frame it. But if we're not able to deduct those expenses, then technically that's going to be higher taxable income for businesses. So that's kind of been their stance pretty early on, and they've really kind of only doubled down on it. One of the things, as we were kind of going through tax planning and year-end stuff, one of the things that we were discussing amongst ourselves was the possibility of, hey, maybe we can delay applying for forgiveness until 2021, and maybe be able to still deduct those expenses in 2020, and kind of hold out some hope that Congress came out with some additional wording in future relief bills to kind of push the IRS's hand to allow those expenses to be deductible retroactively. But the IRS, so a couple weeks ago, the IRS came out with Revenue Ruling 2020-27, which basically put a squash to kind of that thinking. So what that ruling said is that if you're a business that received PPP funds and you reasonably believe those funds will be forgiven at any point in the future, even if you don't apply for forgiveness in 2020, you still can't deduct those expenses. If you reasonably believe they're going to be forgiven, they're just not going to be deductible. And sorry, so I just saw a question come through here from Mike Hart. So he asks if the revenue ruling is still open to potentially change with Congress on the PPP, as my understanding his original intention was for the PPP loans to be tax-free. So again, yeah, we are in agreement that we do believe the original intention was for those funds to be tax-free. And we do think that there's still some hope for Congress to act on that and push the IRS's hand. So I know there's, the relief bills have kind of been in flux all year. But there's hope that maybe in future relief bills, there'll be some wording included in there that'll specify that out. Mike, I don't know if you have anything to add on that.
Yeah, so the current state, and I'm the furthest from the one that has spent a career following politics or whatnot, so I apologize if I misspeak on something here, but essentially the way that they're trying to get a lot of this passed is by attaching it to kind of a reoccurring budgetary process. And the original due date for the next session, right, for this budgetary process that they're trying to get it attached to is midnight on this Friday, so December 11th. There was hopes of getting it done by December 11th. The most recent reading that I've been seeing is they're kind of, as opposed to just ramming it through as a December 11th, right now they're trying to push that deadline back a week to, I guess that'd be probably the 17th or 18th or so. So Mike, yes, the AICP has written letters. Practically all the firm has gone on and written letters to congressmen, congresswomen. A lot of industry groups are really kind of trying to make as much noise as possible, because now that they've issued this 2020-27 and we have to go through the tax return process, assuming it's going to get forgiven, if we think it's going to get forgiven, it really screws things up from we have January 15th, fourth quarter estimated tax payments to be made. And size of these PPP loans, I mean, it's easy for an organization amount of size to have $1 million PPP loan. So now we've got this $1 million swing in taxable income that now we're trying to do January 15th estimated payments. So you can well imagine the noise that's being created out there is very, very significant. We are still very, very hopeful that it actually will get fixed within the next week and a half. And yeah, it's just that's kind of I guess the current state of everything.
I'm just going to go to the next slide, Mike. All right, so this is just kind of, something that we've put together here at WVCO. Kind of have a team of PPP kind of experts that have worked really hard to kind of get this, and we have a forgiveness calculator on our website to just kind of help anybody. You go to our website, there's no like login or anything like that. You need to access it. It's all available there for you. There's this roadmap, there's the forgiveness calculator, there's updates on any new guidance that comes out. So I don't want to dig too deep into this. Just wanted to let you know that it's there and it's available for you if you have any questions on it or have any want to look into that a little bit more.
Yeah, we've got a link at the end of the presentation here. But if you just go to the William Vaughan website, wvco.com, and go to the COVID-19 resource page, you're going to find this here. And kind of that old saying, a picture is worth 1,000 words. If you're just looking to get kind of that whole forgiveness process as a picture in your mind, this is just a great tool.
All right, and so second round of PPP loans, and then the economic injury disaster loans. So there's still potential for a second round of PPP. It's something that we hear about in all of the relief bills that come out. What we're hearing is it might be a little bit more targeted. Might be more targeted to some smaller businesses, and might have some year-over-year revenue reduction requirements, stuff like that. So it's something that we're still watching. Something that we're hopeful comes out. No clear no on when that will come out. The economic injury disaster loan stuff. So the max for those loans are back up to $2 million. So that's something if maybe you applied from early on and kind of got approved for a smaller amount, it'd be something to look into now that the max for those are back up to the $2 million amount. Those loans are based on working capital needs. The formula for those hasn't been disclosed. We haven't done too many of those. Just the terms aren't as favorable, but just want to let you know that's something that's out there as well.
And just a little bit of a reminder. So you are allowed to get both a PPP loan and an EIDL loan, LBN loan, but at any rate, the rule there is that you simply can't use the funds for the same purpose. So if you have an EIDL and you're using that EIDL for payroll, what the rules would say is that you cannot then use that same payroll in your forgiveness calculation for the PPP loan. Unfortunately, as of December 9th, the kind of governmental shutdowns and things of that nature have extended way beyond what anybody's dreams were back in March. So there's still a high likelihood, right, that you could get both a PPP loan and an EIDL and have no problems justifying that they were used for different means. So Ruben brings up an excellent point. If you got an EIDL of a lower amount it's now back up to that $2 million. It's almost a, I guess, a no risk. Might as well submit for it. They're kind of keeping the formula secret, but might as well submit for it and see what you get.
Yep.
We do have a question here from Mike Langendorfer. He says, my loan has been forgiven. Is that a positive or a negative? Should you wait as long as you can to apply?
Yeah, so that's where we were thinking there was going to be a strategy, and waiting to apply was going to be a benefit, and essentially was going to push the issue into the 2021 tax year. So we could file 2020, deducting the expenses, push the issue into 2021. And then hopefully Congress got it fixed. If they didn't get it fixed, then at least we delayed the issue for a year. Because of that revenue ruling, as it currently stands, you need to file your 2020 tax return based on what you think is going to happen. So having it forgiven or submitting the application is neither a positive or a negative. If you thought it was going to get forgiven, you need to file your tax return as if it has been forgiven. So yeah, Mike, there's really not a negative or a positive there. Everything's fine.
Yeah, so the next topics, we just wanted to talk about the potential changes we could see under Biden administration. So obviously we don't know what, if any of these will come about, but we just kind of wanted to make all of you aware of some of the big ticket items that he kind of ran on, and we'll kind of see where they go. And some of these things will kind of feed into some of the stuff that Mike talks about as far in regards to estate planning, income tax planning, those types of things. So first off, one of the things that Biden ran on was the 12.4% Social Security tax for income above 400,000, which would be evenly split between employers and employees. So currently that Social Security cap is 137,700, and there's no Social Security tax above that. Under this change, there would still be that 137,700 cap between that amount and the $400,000 amount. And then once you get above that amount is when Social Security tax would kick back in, and it's unlimited. So there's no cap after that. Next thing would be a shift to the top individual income tax rate of 39.6%, starting at 400,000. Again, that current rate is 37%. That's starting at 518,400. So a little bit there, increase there. The next one, so this is one that some of you've probably heard about, him saying, cap gain and dividend rates increase to the highest ordinary tax rate of 39.6%. But the caveat here that you just want to keep in mind is that that's only for taxpayers with income over $1 million. So that's not every single cap gain or dividend, just for those that have total taxable income above $1 million. The next thing is an increase to corporate income tax rate from 21 to 28%. So if you remember, the TCJA changed the graduated corporate tax rates, changed it to a flat 21% rate. Biden's proposed to change that to a flat 28% rate. And then the next one is the raise in the minimum GILTI tax rate from 10.5% to 21%, and eliminating the 10% deemed return on qualified business asset investment. This might not be that one that a lot of you have seen or need to be aware of. GILTI is for companies that own at least 10% of a controlled foreign corporation. So if you don't own any type of foreign activity, that one's not really going to affect you at all. And in regards to itemized deductions, he's kind of proposed a cap of itemized deductions at 28%. He's proposed restoring the PEAS limitation for income above $400,000. That PEAS limitation was something that got repealed under the TCJA a couple years back. And what that is just a limit. It's like a 3% AGI limit on certain itemized deductions, things like charitable contributions, mortgage interest, stuff like that. And then he's also proposed an end to the SALT cap. So if you remember, the TCJA imposed a $10,000 limit on state and local taxes that you conduct on your itemized deductions. He's proposed removing that cap. And in regards to child incentives, he's proposed expanding the earned income tax credit to older workers. He's also proposed expanding the dependent care credit from $3,000 per child to $8,000 per child for eligible expenses. That's things for like daycare, stuff like that. And then also an increase to the child tax credit from $2,000 to $3,000 as long as the economic conditions require. And then in regards to estate planning, which Mike will touch on here in a few minutes, he's proposed lowering the estate and gift tax exemption to 3.5 million and increasing that top tax rate to 45%, and then also eliminating the step up in basis to fair market value at death. So those are a couple of pieces or a couple of items that could have a pretty big effect on estate planning items, especially for you guys as business owners. And Mike, like I said, we'll touch on that in a few minutes. And then in regards to entire retirements, he's proposed an automatic 401k for those with no access to employer pensions or 401ks, allowing penalty-free hardship withdrawals and distribution for survivors of domestic violence and sexual assault. He's also proposed contributions for caregivers and tax credits to small businesses to offset the costs of starting or maintaining their retirement plans. In real estate, he's proposed a first-time homebuyer credit of up to $15,000. That credit would be refundable and be paid upon the purchase of that home. He's also highlighted a neighborhood home credit for renovating distressed properties in distressed communities, and also a renter's tax credit. And then in regards to QBI, which you remember also came about through the TCJA a couple of years ago, he's proposed ending the special qualifying rules for real estate investors. And a big one here would be phasing out the deduction for anyone with taxable income above $400,000. So there's currently no limit, no income limit for that QBI. So that would be a big change for all of them, for sure.
Thanks, Ruben.
Yeah.
So I guess if you think about the overall message, right, it's obviously everything that Ruben just went over there is kind of speculation, right? It's kind of what Biden was kind of running on, but it certainly does kind of provide for a landscape where right now the indicator would be $400,000 of taxable income is a bit of the line in the sand. And for folks above $400,000, presumably taxes are going up. Both income taxes, so current taxes, in addition to that, kind of this long-term, kind of the estate tax, the gift and estate tax. So we just wanted to spend a couple of minutes on kind of some thoughts and kind of strategies that people might want to consider specific to estate planning. So what's kind of the current landscape here, right? So for 2020, each individual has a lifetime exemption of $11,580,000. So if you give away $6,580,000 during your life, then you've used up $6,580,000 of your exemption. When you pass, you're going to still have $5 million of that exemption that your estate will be able to use on your estate tax return. And then I'm going to jump down a little bit here. You also have this portability, which kind of you can port this $11,580,000 between spouses. So effectively, a married couple currently has $23 million of exemption to be used however they choose, whether that be gifting during their lifetime or whether that be passing assets to their heirs upon their death. Because it's 23 million, it's been 23 million for, well, it kind of was inflationary. It's been 20 plus million for several years now. And it's really caused a lot of individuals to very appropriately say, well, I don't have an estate gift problem, so I really don't need to worry about this. I'm going to go into a couple strategies on the next slide. If this $11,580,000 does go down, I think a lot of us might get a little surprised by kind of the number of people that it is going to impact. But currently it is 11,580,000, 23 million for a married couple. We always want to make sure to bring everybody's attention to the annual exclusion limit of $15,000. When we're talking about estate planning and numbers like 23 million, it's easy to think about $15,000 as really not being all that material. The way that it works is each individual has this $15,000 exemption per donee. So a married couple can actually do $60,000. So if my children are married, I can give my son and my daughter-in-law each $15,000. Then my wife can give both my son and my daughter-in-law $15,000. So as it says here, each individual can do 15, and if you're splitting your gifts, you can actually do 30, and if you're giving to another married couple, you can increase that to 60. So if you go to all the individuals that you're trying to give money to, year after year after year, don't underestimate the power of $15,000 per donee if you feel like you're going to have an estate tax problem. In addition to the $15,000 per donee, specific to the 529 plans, you can basically what's called superfund, front load the 529 plans with up to 5 years worth of the annual exclusion. So how that would work is you would actually put $75,000, and this is per person. A married couple can actually do 150,000. You'd put 75 up to 150 for a married couple into a 529 plan. Those amounts would start to earn in those investment vehicles currently and be able to earn earnings over the next 5 years. And essentially you'd have to file a gift tax return, and you would be consuming that $15,000 annual exclusion for the next 5 years. So that's a couple of things to do with the 15,000 and then the 529 plan. Yeah, we've got a question coming in here from Mike Hart. You're 100% right, Mike. I'm going to talk about that a little bit on this next slide. He's asking about, won't Biden have a difficult time making a lot of these changes if the Republicans hold the Senate next month? 100% correct. So let's actually go to, well, I was kind of surfing around. I kind of like this, right? So the IRS, like the sign says, it's all theirs. Unfortunately, that's right. All right, so what Mike just said, so in Georgia, we have these 2 seats that are open. January 5th, they're going to have a runoff for the 2 Senate seats. In Georgia, there's a requirement that you get at least 50% of the vote to be declared the winner, and none of these, effectively 4 individuals, got 50% of the vote. So we have 2 Senate seats that are up for grabs. If both of those seats are won by Democrats, then the Senate will be 50 Republicans, 50 Democrats, and the tiebreaker goes to Kamala Harris. So if that were to happen, essentially the House, the Senate, and the President would be Democratic, and some of these changes that we're talking about could happen very, very quickly. The more I read, the more you kind of, it's very, very difficult to try and find a news source that is unbiased, right? So every time you read something that has the Republican bend, it's, well, there's no way that both seats are going to go blue. And every time you read something that is Democratic bend, you say, well, the polls are leading here and whatnot. It's kind of playing with fire a little bit because the numbers are so significant. That being said, our prediction is both seats are not going to go Democratic. And so Biden will have a heck of a time changing a lot of these items that we're talking about here in the next 2 years. Really what the unknown is at the end of 2 years. So one of the takeaways that I would encourage everybody to have as we're talking about some of this stuff isn't necessarily it's a December 9th, oh my goodness, I've got to do something in the next 21 days, 22 days before December 31st. That really isn't the intent, because to, I guess, Mike's point, we just don't think that the Senate both seats are going to go blue. And it's going to be some sort of urgency in 2021 that things are going to start changing fast. A lot of the stuff is hard to think through. Yes, it's taxes, and yes, it's saving tax dollars, but it's also somebody's estate. It's something that they've worked a lifetime to put together. It's trying to decide, how are the kids going to get the money? How are we going to structure that to kind of position people to be as successful as they can be? There's just a lot of thought that goes into this. So if we pause and say, okay, well, the Senate's not going to go blue and we have some time to fix this, my fear would be we let the next 18 months go and we're kind of in the same boat, in a kind of a bit of an urgency, maybe at the end of 2021, but certainly maybe into 2022. So really just want to give you some food for thought as far as some strategies that everybody can start digesting, but you really need to be thinking and talking about these months, if not a year, before you actually want to pull the trigger on some of these. So if Biden were to reduce the exemption to what his campaign kind of ran on, right, the 11,580,000 would go down to 3.5 million. So we still presumably have the portability. So we're still at $7 million of exemption for a married couple. So that's still going to cause a lot of individuals to say, I still don't get it. I still don't have an estate tax issue because the exemption is still $7 million. I just want to kind of walk through a little bit of an example here that I think a lot of us that don't think we have an estate tax problem, if the numbers stay constant, could actually have an estate tax problem, because keep in mind that inflation has been fairly nominal over, I guess, a fairly long period of time now. So if you think about the rule of 72, right, you divide the number of years, where you divide the rate of return that you're going to assume by, take 72 divided by the rate of return, and essentially get the number of years that an investment is going to double. So if an investment gets a 5% return, it's going to double every about 14.4 years. If you get an 8% return, it's going to double about every 9 years. If you look at the historical average of a return from the quote unquote beginning of time, it is kind of close to that 8% number. So current life expectancy in the United States of America is 79 years old. So an individual that's 59 years old and sits back and does their kind of personal balance sheet and has a net worth of $2 million, they're saying, I don't get this conversation, just doesn't relate to me. Well, if that same individual that's worth $2 million today continues to earn money, really doesn't spend a lot of their principal on kind of a lifestyle, well, and we kind of assume that, let's just kind of say every 10 years, the investments are going to double, the 2 million is going to become 4 million by the time they're 69. And within the life expectancy, now that 4 million is 8 million as of 79. So I think if we did the math and kind of made some fairly conservative estimates, I think a lot more people could have pay estate taxes than what they really anticipate. So this individual, if it is truly $7 million and they go to 8, that's $1 million subject to taxes. So 45%, currently that's a 40% rate. So that's $400,000 if it goes to 45. So this individual that has $2 million today passes with $8 million. If it truly is $7 million when they pass, they're sending $400,000 to $450,000 off to the IRS. So that's really what we're talking about. That's really what is at stake here. So let me just kind of go through the kind of the ideas that we have here. So the two on the left essentially are kind of freezing tactics. So it's really not getting a lot, it's not getting the current value out of your estate, but it's getting the future appreciation out of your estate. So if we talk a little bit about this guaranteed or grantor retained annuity trust. So it essentially is a GRAP. So current low interest rates is making these ideas that have been around for quite a while, and they were good ideas before. If the facts and circumstances are correct, low interest rates are making these ideas just great ideas. Because essentially the IRS is going to assume that the grant will grow at a given rate, the kind of this kind of hurdle rate, right? And so when you put the assets into this trust, this grantor retained annuity trust, you're actually putting them into real investment vehicles. So under this scenario, maybe you're going to take your investment portfolio and actually put that brokerage account into the GRAT. So if that GRAT grows at an 8%, which currently I think the hurdle rate, because the interest rates are so ridiculously low, I think it's like a 0.6. I mean, so let's assume it's a 1% number. So to the extent that those assets grow at an 8% number and they double and double and double, so you're going to get, let's say, the $2 million. Let's kind of go with this example, kind of back to the 59-year-old that has $2 million today and is going to become $8 million. If you put that $2 million into a GRAT, you're going to consume $2 million of your annual exclusion now, but then those assets are outside of your estate. And as they grow to 4 million and as they grow to 8 million, they're going to pass on to your heirs at that true $8 million value, but they're not going to consume $8 million of your estate tax because you will have gotten them out of your estate when they're $2 million. Another kind of advantage here to the grantor retained annuity trust, it's a grant. The term grantor means that the individual granting the funds is still going to be liable for the taxes. So for income tax purposes, it's still in the grantor's name. So if you truly are worried about the exemption coming down, having an estate tax or having an estate tax issue that you're going to pay estate taxes, 40, 45%, all those rates are incredibly high. If you're worried about having more than that, then there's this extra power here that you get to work your estate down by paying for the income tax on whatever asset you put into the GRAT. So say you have a brokerage account and it's kicking off some dividends, it's kicking off some taxable interest, some cap gains. So as all those taxable items are going to flow through into your personal tax return, further reducing your estate and hopefully further reducing your future estate tax bill. So we can move over to the second one here. Fairly similar idea in all honesty from a concept standpoint. But what we're doing with this intentionally defective grantor trust is you can do a gift or a sale, but what you typically see is you're selling the asset into the intentionally defective grantor trust. Once again, you're really freezing that asset. So a lot of times the GRAT you'll see like with a brokerage account. So if we got the $2 million, so we're going to put $2 million in of a brokerage account into a GRAT. A lot of times with the intentionally defective grantor trust, you're going to see kind of family-owned businesses. So if you have a business that is worth $2 million, you would sell that business for $2 million into the intentionally defective grantor trust. When you sell it into the trust, you haven't gotten the $2 million out of your estate because the intentionally defective grantor trust is going to actually pay you back the $2 million. So you haven't got the $2 million out of your estate. But when that business grows over the next 20 years and it becomes an $8 million business, you have gotten the entire $8 million out of your business with only consuming $2 million of your exemption. Another really powerful component of some of these trusts is what's called a substitution clause. So if, say, we get out 20 years and we believe that there's just a better asset that should be in that intentionally defective grantor trust, let's say that we have a brokerage account that is worth $8 million and the business is worth $8 million, but the basis in our brokerage statement is just a lot higher. So the future capital gains is going to be lower then, and the basis in the business is really low, then we can substitute that asset in and put the brokerage account into the intentionally defective grantor trust, take the business back out of the intentionally defective grantor trust. And then let me pause for a minute here and kind of cover a little different concept as far as this basis step up. Biden's plan has talked about taking away the basis step up, but currently we still have, upon an individual's passing, a basis step up. So start a business and you start it from scratch. So under that scenario, your basis is typically very, very small within that business. grow it to be an $8 million business, then if you passed and you passed the $8 million business on to your heirs, the basis would get stepped up from essentially 0 to $8 million upon your passing. If the family were to turn around and say, well, dad grew this thing, mom grew this thing, they're the ones that really know how to run it, I don't know how to run it, and they were to sell it within some period of time, right? Then their basis is now $8 million. So if it truly has a fair value of $8 million, sell it for $8 million, your basis is $8 million. So the heirs get $8 million cash without paying any tax on it because your basis is $8 million. One of the negatives of estate planning and putting items into a trust during your lifetime is you don't get that basis step up. So that same business in an intentionally defective grantor trust that you put in at $2 million, and then you sell it later on, the gain is going to be significantly more because the family is not going to get a basis step up upon your passing. So that's why the substitution rule is really, really meaningful, because at the end, based upon the fact and circumstances that you really can't predict now, we're talking 20 years from now. If the fact and circumstances are such that my brokerage account has an embedded gain of $2 million and the business has an embedded gain of $7 million, well, we can take a brokerage account, put it into the intentionally defective grantor trust, take the business, take it out of the intentionally defective trust, and then upon your passing, take advantage of that step up. So again, both the GRAT, intentionally defective grantor trust, isn't getting anything out of your estate currently, but it is getting future growth of your estate out of your estate if we're concerned about estate taxes. The next one over is really a strategy if we're really just looking to soak up some of the exemption right now. So we say, I think I'm going to have a problem, and I don't want to just simply freeze the assets. I want to make sure that I'm consuming the exemption before it goes down. So I've got $15 million worth of assets. I get where it's 23 right now. I don't have an issue. If it goes down to $7 million, I do have an issue. So I want to make sure to get things out of my estate right now. So essentially, a spousal lifetime access trust, otherwise known as a SLAT, you're gifting assets between spouses. So one spouse is going to create a trust for the benefit of the other spouse, and they're going to put the assets into that trust. The act of putting the assets into the trust is what is consuming some of your lifetime exemption based upon the current fair value. So you consume it, it is now out of collectively both of your estates for estate tax purposes. So you've consumed the exemption while it is still high, but yet it's for the benefit of your spouse. So it's kind of quote unquote still in the family, right? So this last box here, where I give up your rights to control the gifted assets, your spouse has the access, has access to the benefits of the I guess, asset. Sometimes you'll see these slats set up where the beneficiary spouse is the trustee. If you read enough about it, you really need to kind of find an independent trustee. They're just a lot more stable, secure. IRS doesn't challenge them as much if you have an independent trustee. But you can obviously see with this slat kind of strategy, first and foremost, they become very cumbersome, very messy in case of a divorce. So you really want to consider slats when they are very stable as marriages, if you just don't have that concern. And then also this independent trustee, you just gotta have comfort that the independent trustee is going to honor your wishes because it's going into a trust. You actually are giving up that asset. The last one here, charitable lead annuity trust. So it's a little bit like the graft, but as opposed to kind of paying yourself this annuity back, the annuity component is actually going to a charity. And so we can do these one of two ways. One way is what's called a grantor CLAT. So just like the grantor in the other applications, it means that you pay the income taxes on those assets still. And so you're going to continue to burn down your estate because you're paying the taxes. But also, when you take this annuity stream that you're promising a charity, you present value that, you get a current charitable deduction on your tax return equal to that present value. So if you have a liquidating event of a business, if you have a huge bonus coming through, sometimes a CLAT can be very powerful in reducing your income in that current year. And then you're really not promising to give all the money to the charity right that year. You're giving the money over a period of time. There's also this benefit that because the interest rates are so low, what you're obligated to give out of the CLAT is based upon these incredibly low interest rates, but the investment vehicles that the CLAT can be in can certainly outpace that. So you can put $1 million in, have the annuity be exactly equal to that $1 million, get $1 million tax deduction, have the investment returns outpace kind of this IRS hurdle by $200,000. So you put $1 million in, you get $1 million tax deduction, and at the end of say a 5-year period, you get $200,000 back. Because with a CLAT, you can actually be your own beneficiary, or you can pass that $200,000 on to your heirs. If you make it a non-grantor CLAT, then really what you're trying to do is you're trying to transfer these assets onto family members. And so the CLAT itself is going to pay the income taxes. You're really trying to set up that the payment, the annuity to the charity equals the current fair value. So you're really not burning any estate gift exemption when you're putting it into the CLAT, because what you're promising the charity per the IRS math is equal to what you're putting it in. So you're really not giving anything to your heirs. But once again, if let's say that the IRS hurdle is a 1% and it actually earns an 8%, and at the end of it, there's $200,000, and then your kids maybe are the beneficiaries of the $200,000, you've been able to pass $200,000 on to your kids without consuming any of your lifetime exemption. So there are full day seminars that are on just an individual item here. So we really threw out just a lot of information, a lot of kind of ideas. At the end of the day, it really has to do with projecting out what do you think your estate is going to be worth at your passing, getting with your advisors, trying to take your best guess of what do you think the gift tax exemption, the estate tax exemption is going to be at your passing. If you think you have an estate tax, if you're going to have an estate tax bill, because the amounts are very significant, 40 to 45%, then you want to start thinking about, okay, is this that I don't have an estate tax problem today, but I'm going to have one. So you might want to start talking about some of these items that freeze the assets. If you say, no, I actually have an estate tax problem today, then you might start talking about some of these charitable lead annuity trusts or the SLATs. All right, so now we're talking a little bit about some year-end income tax planning ideas. So the CARES Act is trying to bring in some provisions to put some money back into families and businesses' pockets, to the extent that 2020 was a loss year. So a couple years ago, tax reform took away what is called a net operating loss carryback. So we can no longer carry back our losses. So if we had a huge income year, paid a bunch of money to the IRS, then we had a loss, we couldn't go back in time and collect that money back. We simply just had to use that net operating loss on a go-forward basis. Well, the CARES Act on just a limited time basis here is bringing back this net operating loss carryback. So any net operating losses from 18, 19, or 2020 can be carried back to the previous 5 years. So if you had a loss in 18, that loss can actually be carried back to 2013. So if we did 2013 going forward, if we had taxable income and we paid money into the IRS, we can file for this NOL carryback and essentially get that money back. Something else that the CARES Act did is when we're kind of going through this, the calculation of applying the NOL, on a go-forward basis, you're only able to apply 80% of the NOL to your taxable income. So if you had $100,000 of income in a year and you had $100,000 of NOL to use, you can't eliminate your taxable income. You could only take it down to $20,000. So the CARES Act actually eliminated this 80% rule through the 2020 tax year. So you can actually use your NOL and take your taxable income all the way down to zero. So what are the benefits of doing this? Well, if we paid money into the IRS, then we can go and we can just get cash back, right? But also an additional benefit is like C Corp rates are now 21%. They were higher. Ordinary income rates were reduced via the as tax reform. So because 18 can go all the way back to 13, obviously 19 can go back to 14 and 20 can go back to 15. So we're back in a period of time where the tax rates were higher. So we can actually take these NOLs and carry them back to a period of time when the tax rates were higher and actually get even more of a benefit than if we were to be using those NOLs, I guess, currently. So just something to be aware of if you do have NOLs in any of these 3 years. So another item that the CARES Act did is, and this doesn't apply to a lot of people, but we find that when it applies, it's just a really bad answer. So say that you own a couple of businesses. One is this business that's been around for 20, 30, 50 years and is really, really profitable, is really kind of that cash cow. And you've got another business that you hope to be the next cash cow 20 years from now, but it's in that development stage. And so you've got one business that makes a lot of money, another business that loses a lot of money. And you're not doing that from a mismanagement standpoint. You're just doing that because you want that. I mean, the cash cow doesn't stay around forever, right? So you do have a lot of folks that kind of get into a couple of different business ventures. Well, previous to tax reform, if you had $1 million of income from one business and $1 million of losses from another business, you didn't have to pay any taxes, right? It was a wash. You just got to apply the $1 million against the $1 million of income, and you didn't have any taxes. What tax reform did was it limited the amount of business losses that you could use to $250,000 per person or $500,000 for a married filing joint couple. So go back to the example, you got a business that makes $1 million, you're investing in another business that is losing $1 million. Historically, we've been able to wash those. Well, with the ICE tax reform, that got limited. Now the married couple can actually only take $500,000 of the loss and apply it to the business income. So now you're going to have a scenario where economic reality, you made $1 million, lost $1 million, but you still have taxable income of $500,000. So the CARES Act actually eliminated this for just I guess a period of time. So the new effective date of this excess business loss rule is January 1, 2021. So we don't have to worry about the excess loss rules for 2020, but just something to be, I guess, aware of that 2021, we're going to have to start worrying about that again. Some folks on the call might kind of recall kind of the tax accountants talking about qualified improvement property and that there was a error made in tax reform and that this qualified improvement property was supposed to be eligible for bonus depreciation, but they made this error and they're supposed to fix it. And then it was kind of the never-ending story. Next year, we'd say, yep, they're supposed to fix it, but they haven't fixed it yet. And then the next year, well, they're supposed to fix it, but they haven't fixed it yet. Well, they took the opportunity in the CARES Act to basically make the technical correction. So all this doubt and uncertainty and ambiguity around qualified improvement property is now fixed. So qualified improvement property. So if you go in and you kind of fix the inside of a building, that's now going to qualify as a 15-year property and therefore eligible for bonus depreciation. And we just got a question here. Does the NOL 80% limitation begin again January 2021? Yes, the 80% NOL limitation as currently written, the kind of the period of time that the NOL rules have been modified is only through 2020. So the 80% NOL limitation does begin again January 2021. A couple of other things just to kind of keep in mind, there's nothing really new here, but we are seeing some folks that maybe aren't taking as much advantage of this as possible. So we're talking accounting methods and just the way that you account for something resulting in lower taxable income and therefore lower taxes. So previous to tax reform, several of these items were kind of in that $1 million of revenue, maybe $10 million of revenue. But these ideas here are if your prior 3-year average is under $25 million of revenue, then you have some options as it relates to how you account for things. So companies with inventory, previously, you really had to follow the accrual method if you had much revenue at all. So if you have under 25 million of revenue, previous 3-year average, you can elect the cash method of accounting versus the accrual method of accounting. Why does this, I guess, make a difference, right? So if a company has, let's say $100,000 of accounts receivable and their accounts payable is only $20,000. So we have $80,000 of difference between accounts receivable and accounts payable. Then when you kind of work through the math, you are recording $80,000 more of taxable income when you're recording those receivables on your tax return. So if you could not follow the accrual method and include the receivables and follow what's called the cash method, then you could actually eliminate $80,000 of taxable income from your tax return. And so you're going to save $20,000, $30,000 in your pocket. So that's kind of that cash method. 263A, the IRS has very specific rules as it relates to inventory and costs that you need to include in inventory. And those are typically costs that are in addition to what's on your books. So when we're doing the tax return, we are increasing the value of inventory. Well, unfortunately, whenever we increase the value of inventory, we're reducing the value of cost of goods sold. Reducing the value of cost of goods sold is increasing taxable income. So this booking the Section 263A cost has the effect of increasing your taxable income. So if you're under 25 million for the prior 3 years, you get to elect out and exclude these additional costs from inventory, thereby providing the benefit because your cost of goods sold is now higher, taxable income is lower. Actually, you get to undo inventories altogether, right? You can treat inventory as a non-essential material and supplies and basically not record inventory on your books. And so as you're not recording inventory, you're actually just expensing that inventory as you incur the expenses, which is could be a significant tax burden. This particular idea, though, has an additional wrinkle to it, that there are some financial accounting treatment conformity rules, that as you're doing your internal records, and then also if you're providing financial statements to the banks or whatnot, you need to follow the same methodology on your accounting records as you are on your tax return if you're going to go ahead with a strategy and essentially write off all of your inventory. If you're in the construction industry or even non-construction, just kind of large projects, and you're following the percentage of completion method for accounting for revenue recognition, if you're under 25 million for the prior 3-year average, you can elect out of doing the percentage of completion and just follow completed contract. That will have the effect of any profit associated with any of those jobs will be 100% deferred until the completion of the job versus being recorded throughout the life of the job. We'll go over these kind of fairly quickly as it relates to this. Is just something to be thoughtful of. The interplay between a couple of these items and I guess the PPP loan. So part of the R&D tax credit is qualified research expenses. A lot of times a significant part of the qualified research expense is payroll cost. If you're including the payroll cost in the PPP forgiveness calculation and Congress doesn't fix the issue and those payroll costs are no longer deductible in your tax return, then those same payroll costs that are not deductible in your tax return are not going to be allowed in your R&D tax credit calculation. So if because of the 24 weeks, you have excess payroll, you probably want to be thoughtful as far as what payroll cost you're including in your calculation to try and preserve some of those payroll costs for your R&D tax credit calculation, just in the chance that Congress does not fix it. Kind of a similar thing with Section 199A. This is that 20% deduction that business owners get, but that 20% deduction is limited to, in one version of the calculation, is limited to 50% of the wages. So once again, if under the PPP forgiveness, if those wages, if Congress doesn't fix it and those wages are not deductible, then those wages are essentially not included in your tax return. They're not going to be included in this 199 50% test. And so then you might not get your entire Section 199 deduction. So you might want to consider some strategies that if you have folks that you're going to want to pay bonuses to, we're afraid that the Congress is not going to fix the deductibility, going to take a significant haircut on your 20% deduction. You might want to pay out some bonuses that you might normally pay out January, February, but for whatever reason, they're not deductible in 2020. You might want to just do what you need to do, pay them out early to make those deductible in 2020 to try and preserve as much of your 199A deduction as possible. This qualified for small business stock, it's a very powerful tool, kind of not that well known at times. It really has to do with if you're starting up a new business, consider making it a C Corp if the plan is to create a business and then sell it. Because you can basically exclude the gains up to $10 million. If you sell, there's certainly some rules as far as how long you need to hold it for, but it can be a very, very powerful tool as it relates to starting a business and then selling it. We have a question coming through here that we want to address. And disaster. So I thought you were talking about. So Mike Langendorfer is asking about Section 139. What 139 is think back to hurricanes and tornadoes. It essentially made it, there's a way for an employer to give their employees money in relief for a natural disaster. And you get the best of both worlds. Give somebody $1,000, they do not need to pay tax on the $1,000. The business still gets the deduction for the $1,000. So it's kind of an oddity in the tax code that the business gets the deduction as if it was compensation, but the individual receiving it does not get taxed as if it was compensation, because it is reimbursement essentially for additional cost incurred because of a natural disaster. All the United States, because of COVID, has been declared a disaster area. So actually this IRS Section 139 benefit is something that you're able to do. You're able to essentially give your employees some extra money as a bonus, but really it's in recognition of maybe additional childcare expenses, maybe additional cleaning supplies for the home. Maybe they had to increase their internet at home because now they're working from home. Because it's a natural disaster kind of thing, it does not have a lot of rules around it. It doesn't have, the employee doesn't need to provide receipts back. If anybody's interested in that, we'll be happy to give you kind of some more information. Presently, there's really no limit on it, but because it's becoming more and more popular, the IRS is talking about putting like a $5,000 limit on it as far as how much you're able to give to an employee. But it is kind of a great way if you want to reward your employees. Maybe this is a great time of year from a Christmas bonus time, as opposed to giving them the traditional Christmas bonus and having them pay tax on it. You can frame it as a IRS Section 139 payment. The business still gets the same deduction, but the employee it won't get included in their W-2, and then they will not pay tax on it. So those are the items that we had. As we said at the beginning, our intention was pepper you with a lot of different things, not really with the intention of going deep into any item. But if any of these items kind of sparked some interest, kind of created some additional questions or whatnot, here's our contact information. Please feel free to reach out. A lot of these are very fact and circumstance specific, and we'd be happy to kind of go into more detail with anybody. We got another question coming in here. We applied for and understand that we will receive the SBRG grant. How does this work out for us tax-wise? We are considering using this to bonus our employees. Ruben, are you familiar? What is a SBRG grant?
Small business relief.
Was that one by like Lucas County or Ohio?
Believe so, yeah.
Matt, you're asking this question. Is this the Lucas County one, or is this, okay, that's the state of Ohio. How does this work out for us tax-wise? We're considering using this to bonus our employees. Yeah, so Matt, I'll be honest with you, I don't have a in-depth working knowledge of that state of Ohio grant that came through. We'll be happy to get just a little bit of information. I know that we've got a blog out there on our website specific to it. But as far as what you're allowed to use it for, I haven't heard whether Ohio is coming through kind of like the PPP. I mean, if it's a grant from a tax standpoint, so we'll get some more information to Emily specific to the SBRG, and she can disseminate that out to the group on that one.
Okay, yeah. When I applied for it, it kind of reminded me of the of applying for the forgiveness of the PPP a little bit. It was asking, a lot of things, and basically kind of reimbursement for payroll, rent, mortgage, those type of things.
Yeah, I don't know if what the state of Ohio is doing is because there's such an uproar with the IRS not allowing the deductibility of the PPP. Maybe Ohio's kind of staying quiet right now on the deductibility of those expenses, and kind of letting because certainly if the IRS allows you to deduct the PPP, then it's almost going to be impossible for Ohio to kind of take it in the opposite direction. But yeah, we'll get some more information on that, and Emily will be able to disseminate that out to the group here that's on the call today.
Okay, thank you.
Yep, absolutely. Emily, that's what Ruben and I have. So if we have any more questions, or here to do whatever you like to.
Yeah, thank you both very much. It was a great amount of information that I think we all need right now. So if there are no more questions, then we'll wrap that up. And thank you all for joining us this morning. And thank you, Mike and Ruben. You guys have a good day.
You too. See you.